Hi everyone, this is Jason Bierak of Wall Street from E Street. I just wanted to do a quick video today. It's mostly about bank stocks and the bank's exposure to oil and the share price and the charts for bank stocks. Basically, guys, there's an article on Zero Hedge saying Wells Fargo is bad, but Citibank is worse. I just had the article up, but I had to close it because Zero Hedge makes loading other websites slower, so it was causing problems with this video. But I'll put the link to that article in the text box. And it shows that Citibank has even more exposure than Wells Fargo does. And, you know, obviously there's counterparty risk and things like that. I have the chart up of the XLF, which is the financial sector ETF. So basically it's comprised of larger banks and some insurance companies and things like that. And insurance companies, you know, insure the banks. So these guys are all in one connected, you know, daisy chain with counterparty risk and derivatives market, over the counter and things like that. But basically, though, guys, look at the charts here. So this is a one-year chart. This is not a long-term chart. And, you know, we're cliff diving here, and we're on rising volume. Now, we have articles from Barron's and the mainstream media and on Seeking Alpha and many other places saying, now's the time to buy bank stocks. Well, what they're not talking about, though, when they're trying to get people to buy the bank stocks is, number one, you know, the banks and the financial service companies are their sponsors of these programs. So if you're on CNBC and Bloomberg and you hear the talking heads say how cheap the bank stocks are, well, that's who their sponsors are. So they're being told in their ear by their receiver, by their producer, oh, just politely plug the bank stocks or something like that. Keep on doing it. Or maybe there's a minimum amount that they have to do it per day. But the other major important thing, and you will not hear this mentioned in the Buy Bank Stock Now articles from Barron's and so many others, is they don't talk about how the bank's accounting is so dishonest compared to many other companies. Not that, you know, many other companies use fully honest accounting, but the banks are even worse. And legally, they're allowed to do this. And the rules changed for the banks in 2009, after the 2008 crash. The FASB, which is the Financial Accounting Standards Board, they gave the banks a special exemption. So normally with a business, if your assets fall a lot, if you're a publicly traded company, you have auditing, things like that, reporting to your shareholders, etc., you have to mark your assets to market. So if you had, you know, a $100 million asset, you know, a stock or a bond or something, and you thought it was good, maybe it was an oil company or something like that, and all of a sudden, you know, the oil price fell, 70%, and the oil company was 6 months away from bankruptcy or something like that, and you were still marking the assets at full value, you would be drastically overstating your assets. And there would be penalties, crimes, you know, fraud, things like that down the line if you continue to do so. But the banks are legally allowed to do this accounting fraud. So none of these bullish bank stock articles are talking about this. I think we have a situation, Raoul Pal, who's the business partner of Grant Williams at Real Vision TV, he was on talking about the charts of the bank stocks. He thinks a lot of them are going to zero. The charts are really bad. Let me pull up some other charts of Deutsche Bank here real quick. Yeah, this is the year-to-date chart of Deutsche Bank. Look at that. Oh, man. Well, let's see the max chart. Oh, look, the max chart's even worse. Look at that. Oh, man. Well, guys, and Deutsche Bank has an enormous exposure in the over-counter derivatives market, and it's pretty much the same. You know, we could go to Citibank, see, we could pull up Citigroup here. Let me pull it up on the chart, see. So I just want to give you guys some perspective here about the bank stocks. The bank stocks are signaling that things are going to get much worse. What I will say, though, is that, yeah, look at the Citi chart. Wow, that is pure cliff diving there. A little bottom bounce, but, you know, dead cat bounce looks to me. The volume looks like quite a bit of spike, too. But anyways, though, guys, what I would say is, you know, the banks right now, they're going to fall a lot further due to oil exposure. They don't have that much loan loss reserves. I don't even think they have 1%, all the big banks, for their oil portfolio loan loss reserves. And these are regular loans that have gone bad. So, and that's not even counting the derivatives, which we don't even know the exact amount of oil derivatives with counterparty risk and things like that. So things are going to get a lot worse for the banks unless the Federal Reserve comes in and, announces QE4 or some other scheme to start trying to, fix the banks. So we could see a quick reversal maybe by January. Nothing's guaranteed, but it's possible. I'm sure there's secret meetings and things like that among, the central banks and the treasury departments of countries and the large banks and things like that. But things are getting worse at the banks. The banks are trying to downplay this, but we can tell with the stock charts that a lot of hedge fund managers are short. Now, if you're thinking about shorting, I wouldn't buy the stocks directly for shorts. We've talked about this in the past. The best way to manage risk on shorts is to use options. Now, if you don't know what you're doing with options, there's a lot of options material out there. You have to know fundamental and technical analysis before you buy options. You could be right about a stock going down, but you could be wrong on the timing, or you could buy the wrong option and things like that. So, you have to look at the strike price, and, you want to protect yourself maybe in case the Federal Reserve does announce QE4 in the next, 4 months or 6 months or by the end of the year or something like that. So the bank stock charts are predicting, things are going to get a lot worse. So it'll be interesting to see what the powers that be, the Bank of International Settlements has warned about this. IMF has warned about this. They've, issued warnings for years about the dangers of raising interest rates. The dollar is very strong, or at least it was on a relative basis for the last number of years. A strong dollar can kill the rest of the world economy. And because they borrowed in dollars and their currency is cheaper. So it looks like we're going to have a day of reckoning in the near future, unless the Federal Reserve does QE4. And even then, it might not be enough. It might not be able to stem the tide this time. There's a lot more people that are mainstream, that are not libertarian or Austrian school economists, that are on Wall Street, that are very, very skeptical of the Fed at this point. They believed in the BS recovery after the 2008 crash, that, the economy was recovering. But there's so much evidence now, and look at this in the auto companies, guys. I hear there's 3 tranches now of subprime auto loan debt, and it's being collateralized and chopped up and sold off to pension funds and sucker investors. So there's like the equivalent now in the auto industry of no-doc loans. And we have car companies. I've heard stories from friends of car companies offering, if you had a lease and your lease was about to expire, that you can bring in your car, and if you need new tires for, like, if it's a more expensive car like a BMW and you need to replace your tires for $1,000, they will pay the $1,000 to replace your leased car for the new tires. They will pay overages if you want over on miles, and they will give you like a couple $1,000 of credits and other things to move the cars off the lot. That's how much extra cars for a lot of these companies has been produced. So we're in a situation here where, the banks and the auto industry, they kind of had a fake rally for the last X number of years since 2009. And, that looks like it's going to be coming to an end in the near future. Now, maybe for the auto companies, they can keep giving away like the equivalent of ninja loans and no-doc loans on cars and things like that for a little while longer. But there's 3 tranches of subprime debt now, guys. It's getting ridiculous how easy it is to get a car loan now for the most part. So I just want to thank you for watching this video. I think the bank stocks are ominous. The mainstream media is trying to downplay it, but it's showing, that this is probably why the Federal Reserve may panic. I don't know if they're gonna. Everything's probabilities now. Nothing's guaranteed anymore. They may try to do another rate increase or 2, but the lie that they sold that the economy is recovering. Look at the bank stocks. There's definitely counterparty risk there if the bank stocks are doing this, and it's not just Deutsche Bank. It's the other banks too. Well, thank you for watching this video, guys. We need more 5-star reviews on iTunes, so please go over to iTunes if you haven't and give us 5-star reviews. I would really appreciate it. And if you haven't gotten our report yet, our 2015 review, 2016 preview, sign up for our email address. You can go to the Wall Street for Main Street website, WALSTFORMAINST.com. Thanks for watching the video, guys.